All right, good morning and welcome to finance. So what we're going to do is we're going to just take it section by section, break up the contents, and then if there are examples that we need to use, what I will do is I will put a link to those examples so that you can go and take a look at them, download the Excel spreadsheet or the Word document, and that should be able to help you through. All right, so you'll see there's the contents. The first section is the accounting principles and cycle. The second one is the time value of money. The third one is collecting and presenting economic data. The fourth one is calculating averages and standard deviations. The fifth section is financial planning processes. The sixth and seventh section are combined, and they become financial documents and interpreting financial documents. Then we've got ratio trend analysis, which is section number 8. Section number 9 is assumptions and forecasts. And then right at the end of the process, we have budgeting. So that's where we are headed. Those are the different sections that we need to go through. And so let's get started. We're going to start with the accounting principles and cycle. Okay, so the accounting principles and cycle is the foundation of any accounting practice. We need to make sure that we understand the principles, the fundamentals, in order to make sure that we are really in tune with how things actually work. So let's take a look at some of those things that we need to be aware of. So let's go to page number 3 in section number 1. So the first thing that we're going to look at is what is known as a going concern concept. This is financial statements are prepared on the assumption that the organization is a going concern. That means that it intends to continue its business and is able to do so. So let's take a look at what a going concern actually is. Well, if there's money coming into the business and it is able to then pay the bills that it needs to pay or the expenses that it needs to pay, then it means that it needs to obviously pay tax if it hits the threshold, and that it is able then to continue doing business. If we are getting money in and money's going out, then that means that we prepare financial statements. So if money comes in, money goes out, and we are able to continue doing business, then we are what is known as a going concern concept. Okay, so going concern is a company that is still able to do business and therefore needs to have financial statements drawn up every business year, financial year. Cool. Then we got consistency. Now, consistency means that every department and every part of a business needs to do things the same way. It needs to be able to make sure that everyone is doing things the same way. So if I depreciate my assets in a certain way, every department and every asset needs to be done in the same way. If it doesn't, then the financials that we put out are not going to be accurate. It's not going to give a fair reflection of what's happening within the business. So there has to be consistency in terms of accounting methods. Then what we have is something called prudence. Now, prudence is not just someone's name, it is also an accounting principle. So we need to make sure that when we say our assets are so much and our expenses are so much, that it is a fair reflection. Don't ever overstate, because what happens then is that we open ourselves up to fraud. Let's say I have a Ford Fiesta, and I know that the book value on the Ford Fiesta is 120,000 Rand. If I tell my investors that it is worth 200,000 Rand, what I'm technically doing is overestimating the value of the asset. If I do that, then what starts to happen is that they would make decisions based on an inflated view. If they come into my business and they see that it is not what I said it was, well, then they have legal recourse to take me on. Same thing with my expenses. If I say, well, we only spend 100 Rand on toilet paper per month, and we actually spend 1,000 Rand on toilet paper per month, if I sell shares in that business, I am overstating or understating my expenses and overstating my assets, which means that legally they can actually sue me because I have not been prudent in the way that I've reflected the amounts. Then we've got something called realization. So realization is, when does money become money according to my financial statements? So if I sell someone a chocolate and I give them the chocolate, it could happen that at that point we see the transaction having been taken place. But with other companies, it's when they invoice for their chocolate that the money is then put through the books. Other companies, it's when the people actually pay over the money that the money reflects in the books. So we need to work out, when does our transaction become real in our books? And that's realization. Okay, so realization is, when does the money become real in our financial statements? Because there are some companies that would give a product, but then it has to go overseas. Now, it takes a long time for that money to go over for that product to go overseas. So when does it actually become real in my books? That is what we call realization. Then we have something called disclosure. Now, disclosure is that we need to be telling our investors, our shareholders, and those who are stakeholders within the business that there are certain things that have to be disclosed, be shown to potential investors or stakeholders within the business. So if we believe that in the next year we are going to have a difficult time because there's no more demand for our product, then we have to reflect that in our financial statements. If we have lost money because one of our clients has not paid, we have to disclose that in our financial statements. So disclosure is that we need to show things in our financial statements that could have a negative or a positive effect in our financial future or in our current financial reality. So we have to disclose certain information. If we don't, again, it is not a fair reflection of our financial position. Then we have something called matching. Now, every time we make money, well, normally we have to spend money. And so in order to make money, we spend money, and we need to show that there is a relationship between those two different things in our books. So money comes in, and because money comes in, money also goes out. So I sell ice creams, but I need to buy sugar, I need to buy milk, I need to buy the machinery and the labor to make the ice cream. And so for the money coming in, we got to link it and match it to the money going out. And that gives us a better understanding of how our financials work. So there is what we call a cause and effect. So I get money in, but that means that soon money will go out, or money has gone out and soon money will come in, because it fits that way. So that's what we call matching, is there is a relationship between money coming in and money coming out, and we need to try and reflect that in our financial statements. Then we've got something called objectivity. Now, we always need to make sure that there is someone who only focuses on the actual money coming in and money coming out, and that they don't have an emotional attachment to the business. That's why we get people like accountants from outside of the business, so to show us that that is fair, so that we don't overestimate things, or we don't underestimate things. We want someone from the outside that is going to make sure that our accounting is objective, so that it's not emotional and it doesn't show my bias of what I think should happen, but that there is someone outside that employs certain standards and quality to make sure that we are all on the same page. And then we've got something called the auditor's report. So right at the end of when we have done the financial statements, there is someone that is known as an auditor. They make sure that whatever we have said that we have done in our books are actually done. They come and take a look at our systems and our processes to make sure that it is fair and that it is unbiased and that it is objective. And then what happens is, if there is something that is not according to our processes and our systems that we have said, they will call it a qualified opinion. So qualified opinion means that they say there are certain things that in the set of books that are not done in the way that they said they were, and these are the things that we need to highlight. But if everything is done according to the book, everything is done completely according to the processes and systems, then what we say is we get a clean report from the auditor. So the auditor will put a report in front of the financial statements to say that everything has been done properly, or there are certain things that we need to watch out for based on what they have seen. So they have to come in and almost be the referee to make sure that everything is legal, compliant, and the processes and systems that we say that we follow actually have been followed. Okay. So that is the accounting principle. Now we need to look at forms of accounting. So financial accounting, these are the things that the company does, and it has to be done according to a certain set of rules. In this workbook, it's called GAAP, which is Generally Accepted Accounting Practices. But in the reality in this world at this moment is the International Financial Reporting Standards, which is known as IFRS. So we have to do things in a certain way. We have to record transactions. Then we put actions into what we call journals. Then those journals turn into financial statements. And we need to follow what the rest of the world is doing in terms of how to capture those specific transactions so that we know that our financial statements are right. That is financial accounting. Then management accounting is taking all that information that we got out of our financials and then trying to work out how we have done as a business. So operationally, we need to use the information we have received and make better management decisions. So management accounting is taking the financial accounting, analyzing it, looking at the data, and using that data to make better decisions for the business going forward. We might also put things like budgets together, forecasts together, sales reports together based on the financial accounting that was done. So financial accounting teaches us the cold calculated finances of the business. We take that and then we use the data to make good financial decisions in terms of the business, in terms of the operations, and that is known as management accounting. Then we have something called bookkeeping. So bookkeeping is making sure that we say that there is people that are going through the process of taking slips, of taking invoices, and putting them into our financial books. There are also certain other things that go into that, things like depreciation, things like bank charges that perhaps don't have an invoice and a receipt, but they put that all together and they make sure that the process is being followed. So these are the 8 steps of accounting that the bookkeeper would help us through. The first thing is that we go through transactions. So that is step number 1. We go through transactions, so we get slips, we get invoices, and then we need to put them into separate, what we call journals. Now, in the old days, we had cash receipts journals and cash payments journals. So we'll see the money coming in and the money going out. Then we've got to post it to the different sections of the business. So stationery, okay, so what money went out for stationery? We've got to allocate it to stationery. Oh, what money came in? Oh, there was money that came in for rental. We need to post it to the right account. There was money that came in for sales. We've got to post it to the right account. So we call those line items just to give us a better understanding of where our money has gone to and how our money came in. Then we go through what is known as a trial balance. So this is before we have official books. We need to put it into a trial balance, which looks at this is the money that has come in, this is the money that has gone out, what were they for, so that we have a good understanding of the business. Then we need to go through each of those different line items, and we might have to make adjustments. Those are the things that are in the worksheet. So we got depreciation. There's no invoice for that. There's no receipt for that. So now we need to work that out on a worksheet. We also have to pay tax, and the tax is according to a certain percentage, and we put that in a worksheet. Then we take those worksheets and we adjust the journal. Okay, so we go back all the way to phase number 2, and we need to maybe adjust the journal or put in new line items based on what we picked up in the worksheet. From the adjustments in the journal, we then develop financial statements. And so a little bit later, we're going to look at what is a balance sheet, what is an income statement, what is cash flows, and all of those things are our financial statements, which shows us the financial position of the business. Then once everyone is happy, once the auditors have come in, they've made sure that we have got everything right, then we close the books. The books are then closed for that specific accounting period, and we have financial statements that are accurate, and then we can send them out to investors, and we can send them out to stakeholders, and we send them to the bank, and we send them to those who have loaned us money, so that they know this is the financial position of the business. So that is the accounting cycle. So over there from page number 6, they'll tell you about the transactions, journal entries, posting, all of that. You can go deeper into that through those different pages. Now we are going to go to formative assessment number 1. Now, formative assessment number 1 is on page number 8. And what we are going to do is we are going to tell the assessor one of the accounting conventions, or what are the accounting principles, and how they connect to one of these business quotations or statements. So we've looked at consistency, going concern, prudence, realization, disclosure, objectivity, and matching. Now what you're going to do is you're going to read these different quotations and statements and see how one of those principles connects to the statements. So the speed of the boss is the speed of the team. Honesty is a very expensive gift. Do not expect it from cheap people. That's done by Warren Buffett, a very prominent investor. A business that makes nothing but money is a poor kind of business. That is Henry Ford, the guy who created Ford. You can have $1 million, you can't have $1 million dream without a minimum wage work ethic. Whenever you see a successful business, someone has made a courageous decision. That is by Peter Drucker, who's a management guru. And then lack of money is no obstacle. Lack of idea is an obstacle. So what I want you to do is to take one of these statements, okay? And then consider its value in the world of business today, its relevancy and its importance to how you operate in the business. So let's say, you know, in my business, you can't have $1 million dream without a minimum wage work ethic. So we have to work hard in order to make the operational vision and mission work, because that is the way that those two connect. And so you're explaining why you like that specific quotation. Then what you're going to do is you're going to link it to a specific principle. So let's say we say, okay, you can't have $1 million dream without a minimum wage work ethic. So that is consistency. We need to be consistent in the way that we do things in order to make sure that we achieve our vision and our mission. And that's how it links to that specific statement. So that's how you're going to answer formative assessment 1. Okay, and then once you have done that, you are going to self-score over there, self-score on page number 9, and if you self-score on page number 10, and then what we would want you to do is just to present it to someone who is close to you. So either when you go home, present it to a friend, or you can present it to a colleague if you are doing this at the workplace. Okay, and then you self-score on page number 10. Then the summative assessment. Okay, describe the function of the accounting cycle and draw a diagram to illustrate the stages of the cycle. So let's take a look at the functions. So that should be on page number 5. Okay, so what you'll see is the different forms of accounting and why they are there. Then what you are going to do From there is you are going to give me the reasons, the functions of why we need the accounting cycle, and then what are the stages. So you've seen that picture of the transactions moving to the journals and all the way around to financial statements, and you are going to put that in on page number 11. Okay. So then question number 2, describe the function of the accounting conventions and give practical examples of how at least 3 of those could apply in your own business. So why do we have the accounting conventions? Well, go back to those notes and tell me why. Well, the financials are only going to be fair and accurate if you apply the different conventions. Then let's look at 3 different examples. So consistency, disclosure, objectivity, matching, audit reports. Give me examples of how those principles work in your business. So consistency. Everyone in our business uses the same accounting tools and packages to make sure that there's consistency. Okay. Then example number 2. We can say going concern. Every year, we need to make sure that we have enough money to pay all of the salaries, to pay all of the expenses in order to continue doing business. So you use 3 examples of the different accounting principles. All right, so that is section number 1. Hopefully that made sense. Again, if there's any problems, you know how to contact me, and you feel free to contact me after going through that section. And if you're stuck, you know to ask me some questions.